The journey to trading success is less about discovering a secret formula and more about mastering a set of enduring principles, as demonstrated by some of the most accomplished investors in modern history. This exploration distills the collective wisdom of these market masters, revealing that extraordinary results stem not from magical prediction but from a rigorous personal and strategic discipline. The core insight is that thriving in the markets is a deeply human endeavor, requiring alignment between one's methods and innate personality, resilience through inevitable setbacks, and an unwavering focus on preserving capital. A foundational step is the critical task of aligning your trading methodology with your unique personality and beliefs. There is no single correct way to trade. What works for one legendary figure may be a path to ruin for another. Consider the contrast between a long-term, fundamentals-focused investor like Jim Rogers, who identifies macro trends years in advance, and a technical trader like Marty Schwartz, who thrives on short-term chart patterns. Both achieved phenomenal success, but only after they abandoned approaches that clashed with their instincts and embraced styles that felt authentic. Michael Marcus's early career, marked by rapid losses following others' advice, only turned around when he developed a short-term system based on his own synthesis of fundamentals and chart patterns. Your first task is not to chase a guru system, but to engage in honest self-reflection to discover the approach that fits you. This path is invariably paved with initial failures, which are not a verdict on your potential but an essential part of the education. Every master trader has a history of early mistakes and painful losses. Paul Tudor Jones began his career with a trade that nearly wiped out his account, leading to him being fired from his job at the Cotton Exchange. Instead of retreating, he used the experience to build an obsessive focus on discipline and risk management, eventually becoming the chairman of that very exchange. Persistence in the face of failure is the non-negotiable price of admission. These early struggles provide the raw material for growth, teaching lessons that theoretical knowledge cannot. The key is to treat losses as tuition for invaluable education, not as reasons to quit, allowing you to build the skill and resilience needed for the long journey. Above all else, the paramount principle that separates professionals from amateurs is the relentless prioritization of risk management over profit-seeking. As Paul Tudor Jones advises, the focus must be on protecting what you have, not on making money. Effective risk control can make a mediocre strategy viable, while poor risk management can doom a brilliant one. Bruce Kovner institutionalized this by defining his maximum loss on a trade before he ever entered it, thereby removing emotion from the exit decision and avoiding the sunk cost fallacy. Stephen Cohen advocates a tactic of selling half a position if in doubt, a method of incrementally reducing exposure. This mindset requires humility, an acceptance that being wrong is frequent and inevitable. The goal is not to avoid losses, which is impossible, but to manage them so gracefully that you live to trade another day with your capital intact. Closely tied to risk management is the cultivated virtue of patience. The amateur's urge to be constantly in action is a major source of underperformance. True professionals understand that their edge comes not from frequent trading, but from waiting, sometimes enduring long periods of boredom, for the rare, high-conviction opportunity where the odds are strongly in their favor. As the classic text asterisk reminiscences of a stock operator asterisk notes, the big money was made not in the thinking, but in the sitting. Bruce Kovner avoided the temptation to overtrade by refusing to have a live quote machine at his desk, viewing constant price data as a slot machine designed to trigger impulsive behavior. Like a predator patiently stalking its prey, successful trading involves conserving energy and capital until the perfect moment arrives to act with conviction. Finally, long-term success demands intellectual flexibility. Markets are dynamic ecosystems, and strategies that worked in one era can become obsolete. The ability to adapt your views and methods in the face of new evidence is a hallmark of the greats. Paul Tudor Jones demonstrated this brilliantly during the 1987 crash, rapidly shifting from a heavily bearish stance to a new view as market conditions violently changed, thereby avoiding disaster. Stan Druckenmiller observed the same quality in George Soros, who could fluidly reverse a major position based on a shift in the macroeconomic landscape. Rigidly clinging to a single view or system is a guarantee of eventual failure. The successful trader respects the market's power to change and remains humble and agile enough to change with it. Ultimately, the wisdom of these market masters converges on a philosophy that is as much about inner development as it is about external strategy. It involves knowing yourself, managing your emotions, protecting your resources with discipline, waiting for true opportunity, and maintaining the flexibility to learn and adapt. By internalizing these principles, you demystify the process and build a sustainable framework for decision-making, turning the chaotic arena of the markets into a field where discipline and self-awareness can consistently thrive.